Hi friends, here in this video we are going to continue with final accounts. Already we have discussed what is meant by final accounts, why final accounts are prepared, and what is trading account, what is P&L account, what is balance sheet, why trading account is to be prepared, and how trading account is to be prepared, and what is P&L account, and why P&L account is prepared, and what is balance sheet, and how it is prepared, and we have discussed almost all the relevant adjustments. Here in this video we are going to discuss some small problems to digest the entire topic. Let us start with the problems, friends. From the following information, prepare a trading account of measures ABC Traders for the year ended 31st March 2009. Opening stock rupees 1 lakh, purchases rupees 6 lakh 72,000, carriage inwards 30,000, wages 50,000, sales 11 lakhs, return inward 1 lakh, return outward 72,000, closing stock 2 lakhs. Friends, let us prepare trading account. Already we have discussed that in trading account we show all the direct expenses to the debit of trading account, and all direct incomes we show to the credit of trading account. In the books of measures ABC Traders trading account for the year ended 31st March 2009. Opening stock. Opening stock is to be debited, friends, to opening stock rupees 1 lakh. Purchases 6 lakh 72,000. Purchase is a direct expenditure related to direct purchases, and if any purchase returns are there, the same are to be deducted, friends. Here we have returns inward 1 lakh, return inwards means sales returns, return outward means purchase returns, friends. I repeat, returns inward means sales returns, return outward means purchase returns. Purchases are inwards, purchase returns are outwards. Sales are outwards, sales returns are inwards. So if any purchase returns are there, the same ought to be adjusted from the purchases. Then 6 lakh 72,000 minus 72,000, then it is 6 lakhs. Then carriage inwards. Carriage or carriage inwards does amount to direct expenditure. Carriage outwards or carriage on sale is indirect expenditure. The same will be reflected to the debit of P&L account. So then carriage inwards will be debited to trading account, that is to carriage inwards rupees 30,000. Then wage is a direct expenditure, friends. Salary is an indirect expenditure. So since wage is a direct expenditure, is to be debited to trading account. To wages rupees 50,000. Sales is the direct income, friends. It is also called as a turnover. Then sales, since it is an income, the same is to be credited to trading account, that is by sales 11 lakhs. Then if any sales returns are there, they are to be deducted from the sales. Here we have return inward, that is sales returns of rupees 1 lakh. The net sales will become 11 lakhs after deducting rupees 1 lakh from 11 lakhs. That is sales 11 lakhs minus return inward, that is sales returns 1 lakh 10 lakhs. Then closing stock. Closing stock will be credited to trading account, friends. Then closing stock 2 lakhs. Then we total and balance the account, friends. The total credit total is 10 lakhs plus 2 lakhs 12 lakhs. Then by deducting from 12 lakhs rupees 1 lakhs, rupees 6 lakhs, rupees 30,000, rupees 50,000, we are getting 4 lakh 20,000. Here credit balance is more than the debit balance, then it does amount to gross profit, friends. The same will be transferred to profit and loss account. Then from the information given in above problem, pass necessary closing entries in the journal proper of measures ABC Traders. Then we will see the entries, friends, in the books of measures ABC Traders journal proper. First, only adjusting entries we have to show, friends, and closing entries we have to show. Here we have return outward. When the returns are made, that is purchase returns are made, the entry supplier account data, if it is a credit purchase, cash or bank account data, if it is a cash purchase, to return outward account. Then return outward account balance is to be transferred to purchase account, friends. When it is transferred to purchase account, the purchase account balance will come down, friends. Then since return outward account is showing here credit balance, when it is transferred it will be debited. Then the entry is return outward account data to purchases account. I repeat, friends, return outward account data to purchase account, that is rupees 72,000. Then similarly sales returns. When sales returns takes place, the entry is return inward account data to debtor account. When sales takes place, debtor to sales, and because of the sales returns, the goods are coming back, then return inward account debtor or sales returns account debtor to debtor account. Since sales returns are showing return inward account is showing debit balance, when it is transferred it is credited, friends. Okay, because of such returns, sales volume will come down. Sales shows credit balance. When the sales volume come down, when the sales figure come down, it is to be debited, friends. Then the entry is sales account debtor to return inward account. Then we see other entries, friends. Your sales, the net sales, that is rupees 10 lakhs. It is credited to trading account. Then entry is sales account at R2 trading account. Sales account at R2 trading account 10 lakhs net sales. The next entry trading account, debtor to opening stock 1 lakh, to purchases, that is net purchase after deducting purchase returns rupees 6 lakhs, to carriage inwards rupees 30,000, to wages rupees 50,000, that is trading account at 7 lakh 80,000, to opening stock 1 lakh, to purchases 6 lakhs, to wages 50,000, to carriage inwards 30,000. Whatever the items are debited to trading account, the entry is possible for the same, friends. Then here closing stock account at R2 trading account. Already this entry we have discussed, friends. Closing stock account at R2 trading account. Closing stock account at R2 trading account 2 lakhs 2 lakhs. Then the balance of the trading account will be transferred to P&L account, friends. First the entry is to close that trading account at R2 gross profit account. Trading account at R2 gross profit account. The same gross profit will be transferred to P&L account. Here gross profit is showing credit balance. When it is transferred to P&L account, it is debited, friends. Then with that gross profit is cancelled. Then gross profit account at R2 P&L account. The ultimate entry will be trading account at R2 profit and loss account, friends. Next problem we'll see how to prepare P&L account and how to show the necessary closing entries in the journal proper, friends. Then revenue, expenses and gross profit balances of measures ABC traders for the year ended 31st March 2006 were as follows. Gross profit 4,20,000, salaries 1,10,000, discount credit 18,000, discount debit 19,000, bad debt 17,000, depreciation rupees 65,000, legal charges rupees 25,000, consultancy fees rupees 32,000, audit fees rupees 1,000, electricity charges rupees 17,000, telephone postage and telegrams 12,000, stationery rupees 27,000, interest paid on loans rupees 70,000. Prepare profit and loss account of measures ABC traders for the year ended on 31st March 2006. Friends, already we have discussed that expenses, that income will appear to the debit and credit of trading account, whereas indirect expenses, indirect incomes will be debited or credited to P&L account, friends. The very purpose of the preparation of P&L account is to ascertain net profit or loss. The same net profit or loss will be transferred to capital account. Here first let us see the preparation of P&L account in the books of measures ABC traders for the year ended 31st March 2006. Your debit, credit, particulars amount rupees, particulars amount rupees. Gross profit. It is a profit, friends. Profit shows credit balance. It is been transferred from the trading account. Then the same will be shown to the credit of P&L account, friends. Then by gross profit brought down rupees 4,20,000. If it is a gross loss, it is debited to P&L account. Then salaries. The salaries, it is an expenditure, indirect expenditure, and the same is to be debited. That is two salaries 1,10,000. Discount credit. If it is given credit, it is a discount received, friends. Discount debit means discount allowed. Discount credit means discount received. It is an income. Income is to be credited to P&L account. That is by discount received 18,000. Then discount debit, that is discount allowed. It is an expense and the same is to be debited to P&L account. Discount debit rupees 19,000 is to be debited to P&L account, friends, 19,000. Then bad debts. Bad debts is a loss, and if it is a loss, the same is to be debited to P&L account. Then since bad debt is a loss and the same is to be debited to P&L account, that is two bad debts 17,000, friends. Two bad debts 17,000. Then depreciation rupees 65,000. Depreciation is a non-cash operating expenditure. All expenses, in all indirect expenses, we have to debit to P&L account. Then since depreciation is a non-cash operating expenditure, the same is to be debited to P&L account. Then to depreciation is equal to 65,000. Then legal charges. Legal charges again it is an indirect expenditure. The same is to be debited to P&L account. That is two legal charges rupees 25,000. Two legal charges rupees 25,000. Consultancy fees, again it is an indirect expenditure. Two consultancy fees rupees 32,000 to be debited to P&L account. Audit fees, the same is to be debited to P&L account. To audit fees rupees 1,000. Electricity charges, the same is to be debited to P&L account. Electricity charges rupees 17,000. Telephone postage and telegrams, it is also indirect expenditures. The same is to be debited to P&L account. To telephone postage and telegrams rupees 12,000. Then stationery 27,000. The same is to be debited to P&L account. To stationery 27,000. Interest paid on loans, it is also an expense, friends. The same is to be debited to P&L account. Interest paid on loans rupees 70,000. Then we need to total the credit side and debit side, friends, the credit total is more, that is 4,20,000 plus 18,000, 4,38,000. From 4,38,000 we deduct salaries 1,10,000, legal charges rupees 25,000, consultancy fees rupees 32,000, audit fees rupees 1,000, electricity charges rupees 17,000, to telephone postage and telegrams 12,000, to stationeries 27,000, to depreciation 65,000, to discount allowed 19,000, to bad debt 17,000, to interest 70,000. Then here to net profit is 43,000. Your trade balance is more than the debit balance. Since there is a net profit, then the same will be transferred to capital account. For the same above problem, we'll see the journal entries, friends. That is whatever the items are debited to P&L account, that is salaries, legal charges, consultation fees, audit fees, electricity charges, telephone postage and telegrams, stationery, depreciation, discount allowed, bad debts, interest, all these items are showing debit balance, friends. When the same are closed and transferred to P&L account, they are credited, then the entry is profit and loss account debtor. Profit and loss account debtor, 2 salaries, 2 legal charges, 2 consultation fees, 2 audit fees, 2 electricity charges, 2 telephone postage and telegrams, 2 stationery, 2 depreciation, 2 discount allowed, 2 bad debts, 2 interest, etc. friends. The same we can see here, P&L account debtor 2, and the items which we have debited to P&L account. Then next, then discount gross profit, that is gross profit account debtor to profit and loss account, gross profit account debtor to P&L account. And then we have created even the discount received, that is the entry is discount received account debtor to profit and loss account. Then friends, the profit we have arrived at rupees 43,000. then the entry is profit and loss account debtor to net profit, profit and loss account debtor to net profit, that is 43,000. And this net profit here, it is showing credit balance, and the same will be transferred to capital account. When it is transferred to capital account, it is debited, friends. Then the entry is net profit account debtor to capital account. Such net profit will increase the capital balance. Here we'll see another problem, friends. The following is the trial balance of C. Wong Ku or Wong Chu on 31st December 2009, trial balance on 31st December 2009, capital account 10,000, stock account 2,000, cash in hand 1,440, machinery account 7,360, purchase account 18,200, wages account 10,000, salaries account 10,000, discount allowed account 500, discount received account 300, sundry office expense account 6,000, sales account 50,000, sums owing by customer, that is sundry debtors 8,500, sundry creditors, sums owing to suppliers 3,700, total 64,000. Then additional information, value of closing stock on 31st December 2009 was rupees 2,700. Prepare trading and P&L account and balance sheet. So let us see simultaneously, friends, the preparation of trading P&L account as well as the balance sheet. Then here first, trading and P&L account of C. Wong Chu of the year ended 31st December 2009, particular amount rupees, particular amount rupees. Then friends, directly we'll see capital. Where capital appears, capital is a capital contribution which is brought in by the owner. The same is treated as a liability as per the concept of business entity, friends. Then capital, if any, appearing on the face of the trial balance, the same is to be shown as a liability to the liability side of the balance sheet, that is capital account 10,000 rupees, capital 10,000 rupees. Then stock account, and whatever the stock is given here, we are given value of the closing stock on 31st December 2009 was rupees 2,700, and whatever the stock is given in the trial balance, that is opening stock, friends, the opening stock is to be debited to trading account, that is to stock rupees 2,000 rupees. Then cash in hand, cash in hand is an asset, cash in hand is an asset, the same will be shown on the balance sheet asset side, that is cash in hand 1,440, friends. Then machinery account again, it is an asset. See, whatever the figures are given here, they are adjusted, friends. We don't have any additional information. Only the additional information is the closing stock, and that will be appearing twice, friends, that is to the credit of trading account as well as on the face of the balance sheet asset side. Then machinery account 7,360, directly will show the same on the asset side since it is an asset, friends. Then purchase account, purchase is a direct expenditure, the same will be debited to trading account, that is two purchases 18,200. Then wages is a direct expenditure, the same is debited to trading account, two wages rupees 10,000. Discount allowed is an indirect expenditure and it is to debited to profit and loss account. That is to discount allowed rupees 500. Then discount received rupees 300 friends. Okay, then it is to be credited to P&L account, that is by discount received rupees 300. Then sundry office expense account is an indirect expenditure. The same is to be debited to P&L account to sundry office expenses 6,000. Then sales is a direct revenue. It is to be credited to trading account, that is by sales rupees 50,000. Then sums owing by customers, sundry debtors are the assets and the same are to be shown on the balance sheet asset side 8,500. Sundry creditors, sum owing to suppliers, that is it is a liability, the same is to be shown on the liability side of the balance sheet. Sundry creditors rupees 3,700. The adjustment is closing stock rupees 2,700. Already we have discussed friends. If it is given in the balance sheet directly, it is shown on the asset side of the balance sheet. If it is given as an adjustment, the same is to be credited to trading account, that is by closing stock rupees 2,700. Again it is shown on the asset side of the balance sheet, that is rupees 2,700. Now we total and balance the accounts friends. Here trading account we have credit side sales closing stock total 52,700. From this 52,700 we deduct to opening stock 2,000, to purchases 18,200, to wages 10,000. We arrive at a gross profit of rupees 22,500 friends. We arrive at a gross profit of rupees 22,500 and the same will be transferred to P&L account friends, that is by gross profit brought down 22,500, which is transferred from trading account. Then discount received 300, total we have 22,800. And then here we have deducted salaries, that is 20,800 minus 10,000 salaries, discount allowed 500, sundry expenses 6,000. The net profit carried down will be 6,300. The same will be transferred to capital account friends. Okay, because of this net profit, capital is going to raise, then it is to be added to capital account. Then we'll see the balance sheet friends. Then capital account already existing, we are given 10,000. This net profit is added to the capital. Then total capital will become 16,300. Sundry creditors 3,700. Then machinery 7,360. Sundry debtors 8,500. Closing stock 2,700. Cash in hand 1,440. Total 20,000. The balance sheet is tallied friends. Friends, here we'll see one more problem. The balance sheet of Thapar on 1st January 2009 was as follows. Particulars rupees. Sundry creditors 15,000, expenses payable 1,500, capital 50,000, plant and machinery 30,000, furniture and fixtures 3,000, stock 13,000, sundry debtors 14,000, cash at bank 6,500, total 66,500. During 2009, his profit and loss account revealed a net profit of 15,300. This was after allowing for the following. Friends, these adjustments are already have been done. No further adjustment is required to be done. Interest on capital at the rate of 6% per annum, depreciation on plant and machinery at the rate of 10%, and then furniture and fittings at the rate of 5%. A provision for doubtful debts at the rate of 5% of the debtors as of 31st December 2009. But while preparing the profit and loss account, he had forgotten to provide for. So friends, these adjustments have not been made while preparing the P&L account. Now we need to make these adjustments. Then number one, outstanding expenses totaling 1,800, prepaid insurance to the extent of rupees 200. His current assets and liabilities as on 31st December 2009 were stock 14,500, debtors 20,000, cash at bank 10,350, and sundry creditors 11,400. During the year, he withdrew rupees 6,000 for domestic use, that is for personal use. Draw of his balance sheet as at the end of the year. Friends, before drawing up of the balance sheet, we'll see the revised P&L account since some adjustments have not been made with regard to outstanding expenses totaling rupees 1,800, prepaid insurance to the extent of rupees 200. Then friends, here let us see, during 2009 his profit and loss account revealed net profit of 15,900. This was after allowing the following. That is, interest on capital is adjusted, depreciation on plant and machinery at the rate of 10% is adjusted, and furniture and fixtures at the rate of 5% adjusted. Provision for doubtful debts at the rate of 5% of the debtors as of 31st December 2009 already adjusted. So no further adjustment is required for this. But while preparing the P&L account, he had forgotten to provide for outstanding expenses totaling 1,800 and prepaid insurance to the extent of rupees 200. The same are to be adjusted, friends. Here the net profit is given. That is, P&L account revised, particulars rupees, Why balance brought down 15,300? Here we are calculating the revised or corrected profits. The net profit is given, that is 15,300. Then what adjustments have not been done, friends? Number one, outstanding expenses totaling rupees 1800. By not providing outstanding expenditure, the profits are overstated. By not providing outstanding expenditure, debit side it is showing less, then the profits are overstated. Since profits are overstated, they are to be brought down. Okay, since they are to be brought down, the same is to be debited to P&L account revisor, friends, that is to outstanding expenses 1800. Then prepaid insurance to the extent of rupees 200. By not providing prepaid insurance, the profits are understated, friends. Since profits are understated, they are to be escalated, they are to be increased. To increase, the same is to be created to P&L account revisor, friends, that is prepaid insurance 200. Then after making these adjustments, the corrected profit is 13,700 and the same will be transferred to capital account. I repeat, friends, credit side we have 15,300 and prepaid insurance we have adjusted 200, total 15,500. From that we deduct outstanding expenditure which is not provided, 1800. Then we arrive at correct net profit, that is 13,700, and same will be transferred to balance sheet. And we prepare the balance sheet now, friends. Then we see here, friends, in the opening balance sheet, the balance sheet of Thapar and as on 1st January 2000 was as follows. Capital 50,000 rupees. Capital 50,000, that is capital 50,000, and whatever the net profit we have arrived at, that is correct net profit, that will be added here 13,700. After adding 50,000 plus 13,700, it will become 63,700. Then here, friends, here during the year he withdrew rupees 6,000 for domestic use, that is drawings. If any drawings have been made by the proprietor, the same ought to be deducted from his capital account. Since his capital balance is going to reduce, then such drawings will be deducted from the capital, that is less drawings 6,000, then it will amount to 57,700. Then we are given, friends, interest on capital at the rate of 6% per annum. Interest on capital at the rate of 6% per annum. Interest is calculated on the opening balance. If no other information is given with regard to, that is 50,000 at the rate of 6%, that is 3,000 will be added. Since such interest on capital is going to increase the capital balance, then interest on capital on 50,000 at the rate of 6% will be added. Then it will become total capital balance 60,700, friends. Then here sundry creditors we have 15,000. Here we are given closing balance, friends. Sundry creditors closing balance 11,400. The same will be taken against the sundry creditors 11,400. And outstanding expenses payable we are given for the current year. The current year, whatever the expenses are payable, the same will be reflected. The expenses payable here 1,500 belongs to the last year, friends. The same will not be reflected here. We are given that 1,800 is the outstanding expenditure. The same will be shown as a liability for the current year, that is 1,800, friends. Then asset side, plant and machinery we have here in the opening balance sheet, that is rupees 30,000, and we are said that depreciation on plant and machinery at the rate of 10%. By charging at the rate of 10%, 30,000 at the rate of 10%, that is 3,000, then the plant and machinery will become 27,000, friends. The opening balance is 30,000, depreciation at the rate of 10% and 30,000 rupees 3,000, 30,000 minus 3,000, it is 27,000, friends. Then furniture and fixtures we are given opening balance 3,000. Then we are said that furniture and fixtures are subject to depreciation at the rate of 5%, and the same will be reduced from the furniture and fixtures value, friends. 3,000 at the rate of 5%, that is rupees 150. Furniture opening balance 3,000 less depreciation at the rate of 5%, 150. Then the net figure is 2,850. Then stock 13,000, that is opening balance, friends. We are given here is current assets and liabilities on 31st December 2009. Stock rupees 14,500, and this is the closing stock. The same will be shown on the asset side, that is 14,500, friends. And then we have sundry debtors closing balance also we are given, that is rupees 20,000. So directly we will take 20,000 rupees sundry debtors, rupees 20,000, and we have said that a provision for doubtful debts at the rate of 5% of the debtors as on 31st December 2019. We are asked to maintain a provision for doubtful debts at the rate of 5%, that is debtors we have 20,000 at the rate of 5%, 1,000, and the same will be reduced. Then 20,000 minus 1,000 is equal to 19,000. Then we are given cash at bank here. Cash at bank figure also closing figure we are given friends 10,350, and the same will be shown directly on the asset side of the balance sheet friends. Then prepaid insurance that we need to adjust, the same will be shown as an asset on the face of the balance sheet, that is rupees 200 prepaid insurance. Then the total is 73,900. The balance sheet is tallied friends. Friends, here we will discuss one more problem. Mr. Mohan gives the following trial balance and some other information. Trial balance as on 31st March 2019, particulars debit rupees, credit rupees. Capital 6,50,000, sales 9,70,000, purchases 4,30,000, opening stock 1,10,000, freight inward 40,000, salaries 2,10,000, other admin expenses 1,50,000, furniture 3,50,000, debtors 2,10,000, and creditors 1,90,000. Returns 20,000. Debit returns we have sales returns friends, credit side returns we have purchase returns 12,000. Discounts, debit discount is discount allowed 19,000, credit discount that is discount received 9,000, bad debts 5,000, investment in government securities 1 lakh, cash in hand and cash at bank is 1,87,000. Total debits 18,31,000, total credits 18,31,000. Other information, that is the closing stock was rupees 1,80,000. Depreciate furniture at the rate of 10% per annum. You are required to prepare trading and P&L account for the year ended 31st March 2019 and balance sheet of Mr. Mohan as on the date. Now let us see the solution friends. First let us see the preparation of trading account of Mr. Mohan for the year ended 31st March 2019, that is particular amount rupees, particular amount rupees. Then see friends, here capital 6,50,000 will be shown on the liability side. Sales is a direct income, it is to be credited to trading account friends. By sales 9,70,000. Friends, immediately we have to see if, whether we have any returns. So returns we have debit side rupees 20,000, credit side we have 12,000. Debit side returns are the sales returns, credit side returns are purchase returns. So debit side returns we have 20,000 sales returns. Such sales returns are deducted from the sales to arrive at the net sales, that is 9,70,000 minus 20,000, 9,50,000. Then we have purchases friends. Purchases are debited to trading account, that is rupees 4,30,000, and immediately we have to check if we have any returns. Here credit side we have 12,000 return, credit returns are purchase returns, the same ought to be reduced from the purchases to arrive at net purchases. Then here 12,000 ought to be reduced from 4,30,000 to arrive at 4,18,000. Then opening stock is to be debited to trading account, that is to opening stock 1,10,000. Then freight inward or freight whatever it may be, the same is to be treated as a direct expenditure and the same is to be debited to trading account, that is to freight inward rupees 40,000. Then salaries friends, salaries is an indirect expenditure and the same is to be debited to P&L account. Then to salaries rupees 2,10,000. Then other admin expense also to be debited to P&L account, that is to admin expenses 1,50,000. Then furniture is an asset friends, it is shown on the face of the balance sheet asset side. Debtors is an asset friends, it is shown on the asset side. Creditors is a liability, it is shown on the liability side of the balance sheet. Returns already we have covered friends. Discount, debit side discount is a discount allowed, it is to be debited to P&L account. To discount allowed 19,000. Credit side discount, that is discount received, the same is to be credited to P&L account, that is by discount received 9,000. Then bad debts is a loss and the same is to be debited to P&L account. Then to bad debts rupees 5,000. Then investment in government securities, investments in government securities is an asset and the same will be shown asset side of the balance sheet. Then cash in hand and cash at bank, the same is also as an asset and it is shown on the face of the balance sheet asset side. Then closing stock was rupees 1,80,000. Since it is an adjustment, since it is not adjusted already, the same is to be credited to trading account as well as it is to be shown on the face of the balance sheet asset side. Then by closing stock rupees 1,80,000, by closing stock rupees 1,80,000. Then depreciate furniture at the rate of 10% per annum. Depreciation is a non-cash operating expenditure and it's treated as indirect expenditure and the same is to be debited to P&L account. Here we have furniture rupees 3,50,000, 3,50,000 at the rate of 10%, that is 35,000 rupees. The same is to be debited to profit and loss account, that is to depreciation furniture 35,000. Then first we total and balance the trading and P&L account, friends. Then we prepare the balance sheet. Then credit side of the trading account, we have sales 9,50,000, closing stock 1,80,000, total 11,30,000. From this 11,30,000 we deduct 1,10,000. Opening stock, net purchases 4,18,000, and freight inwards 40,000. Then we arrive at 5,62,000. The same is treated as a gross profit. Since here credit total is more than debit total, it does amount to gross profit, friend. The same will be transferred to profit and loss account. Then by gross profit brought down 5,62,000, discount received 9,000. Total here we have 5,71,000. Again here credit total is more than the debit total, friends. From this credit total we deduct salaries 2,10,000, depreciation furniture 35,000, admin expenses 1,50,000, discount allowed 19,000, bad debts 5,000, and we arrive at net profit. Net profit carried down, and the same will be transferred to capital account, friends. Then we'll see the balance sheet preparation, and we'll check the leftover item, friends. Capital 6,50,000. 6,50,000 is shown on the liability side, and whatever the net profit we have arrived at by preparing P&L account, the same will be added to net profit, that is 1,52,000. 6,50,000 plus 1,50,000, 8,02,000. Then sales we have recorded, purchase we have recorded, opening stock we have recorded, freight inwards, salaries we have recorded, other admin expense we have recorded. Furniture again is an asset, friends. It is shown on the asset side. Furniture 3,50,000, and we are said that depreciate furniture at the rate of 10% per annum. Depreciate furniture at the rate of 10% per annum. Because of the depreciation, the asset value will come down, and the same is to be reduced from the opening value, friend. That is 3,50,000 minus 35,000 depreciation for the year. Then it will, the book value, the return value will become rupees 3,15,000. Then after that we have debtors. Debtors is an asset. We don't have any adjustment. Directly we'll take here debtors 2,10,000 asset side. Then creditors 1,90,000, it is a liability, and the same will be shown as a liability on the liability side. Then returns we have covered, then discounts we have covered, bad debts we have covered. Investment government securities, it is an asset, friends. The same will be shown on the asset side of the balance sheet. Then cash in hand and cash at bank again is an asset. The same will be shown on the asset side. Friends, then closing stock, already we have discussed that closing stock is shown as an additional information. When it is shown as an additional information, when it is not given in the trial balance, it is to be credited to trading account, as well as it is to be shown on the asset side of the balance sheet as an asset. Then closing stock rupees 1,80,000. Then the total is 9,92,000, friends. 9,92,000, the balance sheet is tallied. Thank you, friends.